Now for a look at some more stocks to watch and overall market talk, Brian Jankowski is with us, Senior Investment Analyst, Fort Pitt Capital. So how are you feeling? I mean, it is Friday. First of all, Monday is a day off, everybody, okay? Juneteenth, market is closed. So if you're going to get those trades in, get them in today. What are you thinking? How are you feeling, Brian?
Absolutely. Thanks for having me on, Nicole. So this week is looking pretty good. We're very happy with how this week has played out, and we think there's been two large developments, ones that go hand in hand. One is on the inflation front. Now, at the start of the week, we saw May inflation come in at 4% year over year, and I think that's a very promising and encouraging sign to see that continuing to trend in the downward direction. Now, number we here at Fort Pitt Capital Group are really watching is the rent equivalent component. Now, earlier in the week also, we had the average national rental prices, which is an aggregate from rental listing companies and property management companies, show that new lease asking rents rose just 2% on a 12-month basis. And that's down versus the double digits it was at just years ago. So it's really a large deceleration that we think is going to eventually start playing into the inflation numbers. Now, the inflation calculations are on a lagged basis. We saw for May the rent equivalents being about 8%. So just all very encouraging signs that inflation is coming down. Following day then, the Fed came out and to no one's surprise decided to hold steady for June. And we think they were encouraged as well by the slowing and downward trend of inflation. But what they're really watching and why I think we're taking a pause is to see how the banking crisis from earlier this year started playing out. I think the expectations and what we've heard from small and medium-sized companies is that their loan standards and rates are starting to tighten and rates increase as these banks pull back a little bit. A lot of expectations are this tightening that we're going to see from these banks are going to be equivalent almost to a single Fed rate hike. So we think it made a lot of sense for the Fed to pause following the good inflation read, and we think that that's helping propel markets right now.
Look, and inflation's going in the direction that they want and things are going in the way they want. It just has to be fast enough so that they don't raise again. I mean, right now they're giving us the idea they're likely to raise again, particularly if the PCE doesn't decline quickly enough. I mean, that's really where we stand. In the meantime, you have picks that you've made, and I'm curious as to, is there a parameter? Are you just looking at each? I know you look at each company carefully, but is there sort of a theme to the kinds of companies you go about picking?
Yeah, absolutely. So we look for really good companies that have, good management, good services or products, and ones that will be able to, take advantage of certain themes going on in the market. So one of the first names we really like is Apollo Global Management, ticker symbol APO. And this is one of the largest alternative asset managers right now, whose primary focus is on credit investing and distressed lending. And we think, taking a step back, we really like this company because of the economics of, the alternative asset managers. They're growing their asset base and they're seeing little to no pressure on the fee front. If anything, some of them are actually increasing their fees. But what we really, really like about this company right now is we think they're going to be able to step in and fill in that gap of lending to small and mid-sized companies that a lot of these banks are going to or are expected to start pulling back. So we think there's an opportunity for them to step in and be big players there. They've been accumulating a lot of assets and have quite a bit of dry powder ready to deploy.
Yeah, understood. And then when you look at a name like Tractor Supply, while it may be down slightly year to date, people love it because it's a dividend payer and buybacks, right?
Yeah, absolutely. And we really like it because of the characteristics of their operations and of their revenue streams. So we think you have to be very selective in the retail environment, giving interest rates and consumer budgets and things along those lines. So Tractor Supply is one of the largest, if not the largest, rural lifestyle retail companies in America. And there's three big reasons we really like this company versus other retailers. One, a large portion of their revenue and their sales come from more discretionary items. In fact, their livestock, equine, and pet food make up about 50% of their revenue. Now, you're not going to stop feeding your animals. So this is a very high recurring revenue stream that we think is more favorable than some of the more discretionary leaning retailers. Tractor Supply also boasts really nice margins. They're able to charge for their product at a nice price, and you should be able to help them shoulder either some declining spending on consumers or pricing pressures on the supply front. But what really makes Tractor Supply stick out, is they don't have a shrink issue like a lot of these other retailers, large discount retailers, have in our reporting recently. I think a lot of it is given the nature of their products. It's difficult to walk out the store with them. So, those three combined, we think position Tractor Supply really well. Long term, this is a company that, caters towards the more rural, low population density areas, and they sell products that are a little bit difficult to purchase online and replicate online. So we think they're really positioned well, short term and long term.
All right. Let's get to what's been going on with Bud Light. So Bud Anheuser-Busch lost the top spot after all the backlash with the Mulvaney situation. In the meantime, as Bud Light is dropping over 25%. We're seeing other names jumping 25% for sales, that is, of their beers. And a name like Constellation Brands in 1 month has an up arrow, while Anheuser-Busch has been under some pressure. Tell me about Constellation Brands.
Yeah, Constellation, I think, is taking advantage of some changing in consumer taste and preferences. So they're a maker of high-end and imported beer and distilled spirits, and they also have a wine offerings. But they're really, really well positioned in the high-end and imported beer market. So they're selling 9 of the top 15 selling imported beers, most notably Corona and Modelo. Like you said, Modelo has now taken the #1 sales lead in the U.S. And the Mexican imported beer category is growing at high single digits, which we really like, given that when you take a step back and look at the whole beer market, they're growing very low, if not flat, on a year-to-year basis. So we expect there to be increased interest, some of this fallout from the Bud Light controversy, that, it'll drive consumers more towards these higher end imported beers. And we think that will play out well for the stock. We think for a while it's been underappreciated. They're really nice profile and offerings on these beers. And we think they'll start being rewarded appropriately and valued up higher.
Yeah, and just for the heck of it, I became curious about all the beer brands. And so Constellation Brands, which has Corona and Modelo, which has been growing, 1 month has an up arrow. It's up 6%. Tap is up 6%. Sam Adams, right, which is Boston beer, but Sam is the ticker symbol. 1 month up 3%. Anheuser-Busch, Bud, has a down arrow. Granted, it's just under 1%, but while all those are gaining, that one's losing. Brian Jankowski, thank you so much. Fort Pitt Capital, great to chat with you. Appreciate it.